Welcome to the deep dive. Today we're digging into a really interesting forecast from investor Chamath Palihapitiya. He's looking at the markets, particularly Bitcoin, for 2025 and beyond.
Yeah, and he paints quite a bullish picture.
Definitely bullish. He's got this whole thesis built around, well, trillions of dollars, just sitting on the sidelines, kind of waiting. So our job today is to unpack that, figure out what he's seeing and what it might mean for you.
It's compelling because he really connects the dots, doesn't he? Macroeconomics, historical trends.
Right.
It's not just one thing. His main idea is this potential for a huge shift in where capital is allocated, a big reallocation.
Okay, so let's start there. This money on the sidelines, how much are we talking about?
He points specifically to about $7.4 trillion. That's trillion with a T.
Wow.
Yeah, parked in money market funds. Basically, super safe, low-yield places.
So kind of like cash under the mattress, but for big investors. Sort of, yeah. And his point is, this isn't apathy, it's patience. Investors are waiting for specific signals, triggers, before they move that money into things with potentially higher returns.
$7.4 trillion. I mean, that is an incredible amount of dry powder, as they call it.
Exactly.
How does he see that actually shifting things when it moves? It sounds like a dam waiting to break.
That's a good analogy. It's potential energy, right?
Yeah.
Stored up in the system. When that money starts flowing, it could create significant upward pressure, not just in one area, but across the board for asset prices.
Okay, so what's the trigger? What makes that dam break?
Well, a big piece of his forecast is the Federal Reserve. He seems pretty convinced that rate cuts are coming maybe sooner than the market thinks.
Rate cuts? Why? Political pressure. Economic necessity.
He suggests a mix of both, really. Political cycles, economic indicators, pointing towards the Fed needing to ease things up.
And that's the signal investors are waiting for.
That's a key one, yeah.
Yeah.
Think about it. If the Fed cuts rates, those safe money market funds become even less attractive. Right, the yield drops further.
Exactly, so the incentive shifts. Capital starts looking for better returns elsewhere, maybe equities, maybe other assets.
So the rate cut is like the green light for that $7.4 trillion to start moving off the sidelines.
It acts as a major catalyst, yes. It pushes capital out of safety and encourages taking on a bit more risk for potentially higher returns. It signals a shift in the environment.
Okay, that makes sense. But he talks about more than just the Fed, right? Something about the velocity of money.
Yeah, the velocity of money is basically how fast money is changing hands in the economy. You know, how quickly a dollar gets spent, then respent, and so on.
Okay.
And after a period where things slowed down because the Fed was tightening, making money more expensive, he sees signs that this velocity is picking up again.
So money's moving faster, people and businesses are spending and investing more actively.
That's the idea. And that faster circulation, it tends to be good news for the stock market, for risk assets generally.
How does that work? Is it just more economic activity overall?
Partly, yes. But it also creates this kind of feedback loop. Easier money from the Fed encourages spending, which increases velocity. Higher velocity makes the economy feel more robust, which boosts confidence.
Which encourages more spending and investment.
Exactly. So easier money and rising velocity can reinforce each other, pushing markets like equities and maybe crypto higher.
Interesting. Okay, so we've got this backdrop. Tons of cash waiting, potential rate cuts, money moving faster. Now let's talk Bitcoin, because his forecast there is, well, it's pretty attention-grabbing.
It is. He throws out a number potentially over $500,000 per Bitcoin by late 2025.
Wow. Okay. $500,000. That's bold. Where does he get that from? Is it just a gut feeling?
Not entirely. It's grounded in Bitcoin's history, specifically something called the halving cycles.
Ah, the halving. I've heard about this. That's when the reward for mining new Bitcoin gets cut in half.
Precisely. It happens roughly every 4 years. And it effectively slows down the creation of new Bitcoin. Engineered scarcity. And historically, after these halvings, we've seen massive price increases, like 8 times, even up to 45 times within about 18 months.
45x. That's incredible.
It is. Now, he acknowledges the returns get smaller each cycle, the magnitude diminishes. But the basic pattern halving leads to significant price appreciation. That pattern is hell.
So reduced supply meets steady or growing demand. Price goes up. Makes sense.
And that demand side is getting a boost too. He points to increasing commercial use, plus the big one, the arrival of Bitcoin ETFs.
Right, the exchange-traded funds. Those make it way easier for big institutions and even regular folks to get exposure, don't they?
Absolutely. They lower the barrier to entry, increase liquidity. It's a game changer for accessibility. So you have the supply shock from the halving combined with potentially much broader demand via ETFs.
That combination sounds potent, but beyond the price prediction, he also talks about Bitcoin's role, like fundamentally. He calls it an uncorrelated hedge. What does that mean in plain English?
Good question. So most assets, like stocks and bonds, tend to move somewhat together. If the stock market crashes, bonds might react in a certain way. We're correlated.
Okay.
Bitcoin, historically at least, hasn't always followed those patterns. Its price movements can be independent of what traditional markets are doing. That's the uncorrelated part.
So it zigs when everything else zags sometimes.
Kinda, yeah. Or it just does its own thing regardless. And that makes it interesting as a hedge, a way to potentially protect your portfolio if traditional systems face stress, or if, say, government currencies lose value, what they call fiat debasement.
So it's not just about potential high returns, but also about diversification, something that behaves differently.
Exactly. He sees it as offering genuine diversification because it's not tied tightly to the same economic factors as most other things. It's a hedge against systemic risk and currency issues.
Okay, that adds another layer to the argument. Now, there was one more piece, I think. Something about global money supply.
Right. M2, money supply, but globally.
Yeah.
M2 is just a broad measure of money circulating.
Got it.
And he makes this really interesting point. While the U.S. has been tightening its money supply recently, trying to slow things down.
Yeah, raising rates, etc.
Many other major economies have been doing the opposite. They've been pumping more liquidity into the global system.
Ah, so it's not just a U.S. story. Money's being created elsewhere.
Precisely. There's this divergence. And Chamath's argument is that Bitcoin hasn't really priced in or caught up to this global expansion of liquidity yet.
Meaning there's potentially more fuel for Bitcoin from international investors or capital flowing out of those other currencies.
That's the implication. As all this global capital looks for somewhere to go, seeking yield or just a reliable store of value, Bitcoin stands out as a potential destination. It's a global perspective that's easy to miss if you only watch the Fed.
Okay, so putting it all together, this deep dive into Chamath's forecast really paints a picture built on several pillars. Idle cash, policy shifts, money velocity, Bitcoin's unique cycle, and global liquidity.
Yeah, it's a multi-layered argument.
Yeah.
The core takeaway seems to be, prepare for potentially significant market moves. He sees trillions shifting from safe, low-yield spots into higher return assets.
And Bitcoin, in his view, is set up to be a major beneficiary of that shift, thanks to its specific supply dynamics and its role as that uncorrelated asset.
That sums it up pretty well. It's a confluence of factors he believes are lining up.
It really makes you think. When you consider that huge amount of dry powder potentially moving and the idea of assets that don't just follow the herd, what does that signal to you about maybe needing to look beyond traditional correlations? Or how might you evaluate opportunities that offer that kind of genuine diversification? Something to definitely chew on.